Cup and handle patterns are one of the staple patterns traders use to predict price action in the future. Stick around to see how you can utilize these patterns to your advantage when trading. How's it going, guys? Ryan here with another episode of my trading guide, and today we're going to discuss one of the most important patterns that you'll use if you're day trading, and that is the cup and handle pattern. But before we begin, please remember to like and subscribe because it helps me out so much, guys, and make sure you leave a comment down below with any queries or questions that you'd like to know. Now let's kick it off. What is a cup and handle pattern? Now, a cup and handle pattern is essentially a continuation pattern, and generally they occur when the trend is in the upwards direction. So if a stock is relatively bullish and it's growing over a slow period of time, it's called a cup and handle pattern because it quite literally looks like a cup with a handle on it. Here's an example of a real life stock that is currently in an uptrending scenario. And what you'll be able to see here is actually a cup and handle pattern. I don't know if you can spot it, but if you can, it is right here. And effectively what you are seeing is the cup forming at the front end of the pattern, and then the handle forming in a consolidation period after a drop and a gain, forming what effectively looks like a cup and handle. As I said before, this is a continuation pattern, so you can see that once the consolidation period has ended between the handle sort of support and resistance lines, you can see that the stock ends up increasing in value. And one of the key things to note when a cup and handle pattern is actually forming, you'll see the top ends of the cup form at that top resistance point, and then once it hits that second resistance point again, you'll see the handle form. The resistance point is really crucial when forming the cup and handle because effectively that is what defines that a cup has been made, and you'll be able to see that the stock bounces downwards off that resistance line at the top to start forming that handle, and that is really a key identifying factor when you're looking for this pattern. What you effectively want to do is then wait until the handle starts to form in its entirety, and what you're looking for is the breakout of the top resistance line as opposed to the bottom support line, as that will indicate the direction of the stock more often than not. As this is a bullish continuation pattern, as I'd mentioned, this means that the price is likely to break through the top resistance point and continue its trend onwards unless there is a major catalyst or event that causes the price to drop drastically. You tend to see the cup and handle pattern form when there is a switch between the aggressiveness of the uptrend towards a bit more bearish sort of downtrend, and that is effectively what forms that handle itself. So generally this is caused by a sell-off of traders and other people who have bought at the bottom end of the cup and they're wanting to get out, but overall it's not a massive dump, so the trend's going to eventually continue and the stock's going to eventually keep increasing in value. You'll tend to see the cup and handle pattern form on the more stable type of stocks that are growing over a long period of time. If you're day trading to the point where you're in and out on almost a daily basis, you won't really see these sort of patterns form intraday, and they normally occur over a period of a few weeks or a few months to form the full cup and handle. So you want to be looking at the pattern on an overall level as opposed to on a weekly chart for confirmation that it has occurred. There are a few different ways that you can use the cup and handle pattern to your advantage, and that is if you see the price start to bottom out at the bottom where the cup has sort of half formed, you want to buy that stock if you're day trading, because then the trend is going to continue up to that resistance point where the cup started to initially form and drop from, and straight back up to that. Once it hits that line, you sell that stock, and then the price will then continue to decrease again, and once again you buy it after it's dropped or after it's broken through the actual handle itself in order to make double the profit. Alternatively, you may have invested in a stock long term, and as a result you're trying to toss up whether the price is going to continue to increase or decrease in value eventually. And what the cup and handle pattern effectively does is confirm that the price action is going to continue to be bullish, and you can safely hold on to your investment and know that it will increase in value relative to the current price. I would recommend that you use the cup and handle pattern in conjunction with some other indicators as well, just for 100% confirmation that the trend is going to continue to increase in value, because obviously a lot of other factors can come into effect when you're trading these sort of patterns. And with that, we're wrapping up this video, guys. I really hope you enjoyed it. If you did, please remember to leave a like and subscribe for more content, and leave any comments, questions, or queries down below in the comments section. And with that, guys, hope you have an awesome day. See you next time.